If Donald Trump wins the upcoming November election, experts predict a potential decline in the value of the US dollar, along with US Treasury bonds. This analysis explores the possible effects of a Trump victory on the currency market and overall economic landscape. Understanding these potential impacts is crucial for investors and policymakers as they navigate the evolving economic landscape. A Trump victory could introduce immediate market uncertainty, causing fluctuations in the dollar's value as investors react to the election outcome. Trump's past criticisms of the Federal Reserve might lead to increased pressure on the institution, potentially resulting in more accommodative monetary policies that could weaken the dollar. In the long term, Trump's protectionist trade policies, including tariffs and trade wars, could negatively impact global trade relations, leading to a weaker dollar as international demand decreases. Significant tax cuts and increased government spending on infrastructure could initially boost economic growth, but the resultant fiscal deficit might reduce confidence in the dollar, causing its value to drop. Trump's policies may lead to higher government spending without corresponding revenue increases, resulting in a larger fiscal deficit. This would necessitate more borrowing through the issuance of Treasury bonds, potentially driving up interest rates. As the supply of Treasury bonds increases to finance the deficit, bond prices may fall, causing yields to rise. Higher yields reflect increased borrowing costs and can signal reduced confidence in the U.S. government's fiscal health. Investors may view a Trump presidency as introducing greater economic and political risk, leading to decreased demand for U.S. Treasury bonds. This can cause bond prices to decline and yields to rise. Increased fiscal spending and potential protectionist measures may lead to higher inflation expectations. As inflation rises, the real return on Treasury bonds decreases, making them less attractive to investors. Increased government spending and tax cuts could boost consumer and business spending, driving up demand and potentially leading to higher inflation. Protectionist trade policies could disrupt supply chains, increasing costs for businesses and contributing to cost-push inflation. While fiscal stimulus may initially boost stock market performance, long-term market stability could be threatened by higher interest rates and inflation. Increased fiscal deficit and inflation expectations could lead to higher yields, affecting the bond market negatively. A Trump victory in the upcoming election could lead to a decline in the value of the US dollar and US Treasury bonds. Short-term market volatility combined with long-term trade and fiscal policies may contribute to this outcome. Stay informed about the possible impact of a Trump victory on the currency market. Watch now to understand what might happen to the dollar if Trump is re-elected as the President of the United States.